Welcome to the Deep Dive, where we filter out the noise and give you the signals. Today, we're putting on our Talk Tickers hats. We're diving into Stratasys' recent Q2 2025 earnings call that was held August 13th. They're a key player, obviously, in additive manufacturing. Our goal here, simple. Pull out the most crucial bits from that call, unpack what it means strategically for you, all straight from what the company actually said. So let's jump in.
Yeah, let's do it. And looking at Stratasys' Q2, the headline results were definitely a mixed bag, and the market saw that pretty much instantly.
Absolutely. So revenue first.
Yeah.
Came in at $138.1 million. Now, that was actually a little bit better than consensus and up just slightly, 0.7% year over year.
Okay, so top line, a modest beat.
Right. Then earnings, non-GAAP EPS, the number that often strips out some of the noise, was $0.83. Bang on expectations. But, and this is a pretty big but, the standard GAAP number, the official accounting one, showed a net loss of $16.7 million. Works out to about negative 20 cents per share.
It's quite a contrast. But, despite that GAAP loss, there were some signs of operational improvement underneath, looking at the non-GAAP figures. Adjusted EBITDA, which is, a decent proxy for cash operating profit, they pushed that up to $6.1 million. That's a good jump from $2.3 million last year.
Okay, so better operational cash generation.
Exactly. And they actually managed a small non-GAAP operating income of $1.1 million. That's a swing from a loss last year. So you can see some better operational leverage starting to show, even if the final GAAP number was red.
Interesting. So some positive operational tweaks under the hood. But you mentioned the market reaction. It wasn't positive, right? Mm-hmm. Despite those points.
No, not at all. It was sharp. And it was negative, the single biggest factor. A pretty significant cut to their full year 2025 guidance.
Yeah, the guidance. That always gets the attention.
Always. It hit the stock hard in pre-market, and it just kept sliding over the next few days. Trading volume went way up, too. The market really keyed in on that forward look.
Okay, that guidance cut is clearly the elephant in the room. Let's dig into the details behind it all, starting with the financials for the quarter. Revenue breakdown.
Sure. So product revenue was $94.8 million, just up slightly from $93.6 million year over year. Within that, the actual systems, the printers, brought in $30.6 million.
And the consumables. That's always a key metric for recurring revenue, isn't it?
Absolutely critical. Consumables came in at $64.2 million. And importantly, that was up 2.6% sequentially from Q1. Now, that's really telling, right? It suggests that even if companies are hesitant to buy new big machines right now, the ones who already have Stratasys systems are using them heavily. That installed base is generating solid, sticky revenue.
That's a great point. Shows the value proposition is still holding up for existing customers. And service revenue.
Service revenue was $43.3 million.
Okay. Now, margins. Non-GAAP gross margin was 47.7%. You mentioned it was down a bit from last year's 49.0% and Q1's 48.3%. What drove that dip?
Management pointed to a few things. The mix of products sold, the usual impact of tariffs, but also something they called higher absorption costs.
Higher absorption costs.
Right.
Okay, unpack that for us. Sounds like accounting jargon.
It kind of is, but it's important. Basically, Stratasys made a strategic choice to reduce their inventory levels quite significantly by over $30 million compared to last year. When you make less stuff to lower inventory, your fixed manufacturing costs get spread over fewer units produced in the period. So more of those costs hit the income statement right away instead of sitting in inventory value on the balance sheet. It temporarily dings the gross margin percentage.
I see. So it looks like a margin hit now, but it's actually about freeing up cash tied up in inventory.
Exactly. It's a positive move for cash flow down the road, even if it makes the quarterly margin look a little weaker. Smart financial management, really.
Got it. That makes sense. And they also managed costs elsewhere, right? Operating expenses.
Yeah, big improvement there. Non-GAAP operating expenses dropped to $64.7 million, which is about 46.9% of revenue. Yeah. That's down quite a bit from $70.9 million or 51.3% of revenue last year.
So those cost-saving efforts they started back in mid-2024 are clearly paying off.
Definitely. Shows real discipline, which you absolutely need when revenue growth is tough. And tying this all together, their balance sheet looks, frankly, really strong. They ended Q2 with $254.6 million in cash and equivalents, and crucially, zero debt.
Zero debt. Wow. That's a solid position.
It is. And it was boosted significantly by that $120 million strategic investment they got from Fortissimo back in June. Plus, management expects to generate positive operating cash flow for the full year 2025. So financially, they're pretty resilient.
Okay. Strong balance sheet, cost controls in place. Which brings us back to that guidance cut. The main reason, they said, was delays in closing big production deals.
That's the narrative, yes.
Yep.
They blamed ongoing macro caution, economic uncertainty, making customers take longer to sign off on big capital expenditures, elongated sales cycles.
And they were careful to say these deals are delayed, not canceled, right? How much weight should we put on that distinction?
That's the million-dollar question, isn't it? Management insists the pipeline is still strong, demand is there, it's just shifting right maybe into 2026 for some deals. But the market reaction tells you investors are skeptical about the timing. Predictability is king right now, and saying it's delayed introduces uncertainty, even if they believe the deals will eventually happen.
Right. Uncertainty equals risks in the market's eyes. So what are the new numbers, the revised full-year guidance?
Okay, the new ranges are revenue between $550 million or $560 million. Non-GAAP EPS between $3.13 and $0.16.
Okay.
And adjusted EBITDA between $30 million and $32 million. So, yeah, a clear step down from where they were aiming previously.
Okay. So a lowered bar for the year. But they did offer some outlook for the second half.
They did. They expect revenue to grow sequentially through the rest of 2025. Q3 should be, in their words, slightly lower to slightly higher than Q2, so sort of flattish. But they're banking on a more significant step up in Q4.
And the key target for Q4 is profitability, isn't it?
Absolutely. They specifically guided for Q4 adjusted EBITDA margin to be 8% or higher. That's a big flag they planted. It signals they believe they can achieve better operational efficiency even on that lower revised revenue base. They even mentioned planning extra cost-cutting measures in Q4 just to hit that target.
So hitting that 8% plus margin in Q4 will be a major proof point for management's credibility on execution.
Huge. It would show they can pull the levers needed to manage profitability despite the top-line headwinds.
Okay, we've got the financial picture. Challenging now, but with some underlying strengths, cost discipline, strong balance sheet. But what about growth? What's driving the future beyond just cutting costs?
Right, because you can't cut your way to long-term growth. Their focus is clearly on innovation and, maybe even more importantly, demonstrating real production applications with major customers.
Let's talk innovation first. What's new?
Well, on the software side, they launched GrabCAD Print Pro 2025. The interesting bit here is integrating software from a company called Rinker 3D. It basically lets users design production-ready fixtures really quickly, hours instead of days, without needing deep CAD skills.
Okay, so making it easier for customers to actually use the printers for manufacturing tasks, not just prototypes, boosts utilization.
Exactly. And they're backing it up by launching a dedicated customer success team just for their software users in Q3. On the materials side, they launched something called P3 Silicone 25A, developed with Shin-Etsu. This is apparently a big deal because it delivers genuine silicone parts flexible, durable without needing expensive molds or tooling. Think seals, gaskets, that sort of thing for industrial use.
Interesting. So expanding the range of actual end-use parts you can make. But you said the real story is in the customer wins.
I think so, yeah. Because it shows the technology isn't just lab stuff anymore. Look at automotive. They highlighted their long-standing work with General Motors. Using Stratasys tech for additive tooling has apparently slashed costs and cut lead times from weeks down to days or hours for GM, supporting EV programs, even improving worker safety. They mentioned GM has their big F900 systems in over 15 plants in North America, running at high capacity.
That's serious integration into manufacturing, not just a one-off project.
Right. And similar story with Toyota. Using Stratasys tech across the board, all 5 of their main technologies, plus GrabCAD software to cut costs, speed things up. Toyota has a goal, they said, to cut vehicle development time by a third using tools like this. These are production-grade examples with global giants.
That really drives home the shift from prototyping to production. What about other industries?
Aerospace. They mentioned Blue Origin buying multiple NEO 800 systems. These are for making investment casting patterns. It points towards future production use in aerospace, maybe even tied to things like NASA's Artemis program.
And medical, always a strong area for 3D printing.
Yeah, the J5 Dentajet system they launched last year seems to be getting traction. They shared a really powerful story from the Hairstone Biofabrication Institute. They used the Dentajet to print a life-sized, patient-specific model of an aorta. Surgeons used it to plan and practice a complex operation, and it directly helped save the patient's life.
Wow. That's incredible. That puts the technology in a whole different light, doesn't it? Beyond just dollars and cents.
It really does. It shows the profound impact it can have. And beyond their own R&D, they've also been smart about acquisitions, especially with some competitors struggling.
Right. They picked up some IP.
Yeah, they acquired IP and materials portfolios from Forward AM that came from an entity that was insolvent, and also IP and know-how from Nexa 3D. Management said they got these on favorable terms, basically buying R&D shortcuts and expanding their capabilities opportunistically.
Using that strong balance sheet to pick up assets while others are weak. Smart move in a consolidating industry.
It seems like it. And one more thing on infrastructure. They launched a new North American Stratasys tooling center with a partner in Flint, Michigan. It's designed to be a hub to help manufacturers actually validate and scale up using additive for tooling in real production settings.
Okay, so a clear strategy. Innovate internally, prove it with big customers, acquire tech smartly, and build the infrastructure to help others adopt. That makes sense.
Let's pivot back to the market context for investors. We know the reaction was bad. How bad exactly?
Well, we mentioned the pre-market drop was around 15%. On the day of the earnings, August 13th, the stock closed down almost 12% at $10 or 1 cent. Volume was huge, like 10 times normal, about 3.3 million shares traded.
Ouch. And it didn't stop there.
Nope. The next day, August 14th, it dropped almost another 8%, closing at $9.22. If you look at the past month, Stratasys is down about 17.5%. Compare that to the S&P 500 being up nearly 3%, and even the 3D printing ETF, PRNT, being up almost 16% over the past year. Stratasys is really lagging right now. That really highlights the disconnect. You have management saying, pipeline strong, deals delayed, we're hitting 8% margin in Q4, but the market is voting with its feet saying, we don't see it yet.
Exactly. There's a major divergence between management's confidence, or at least their stated confidence, and the market's skepticism. Investors seem laser-focused on near-term visibility and predictability and less willing to wait for that longer-term story to play out right now.
So for Stratasys to, as they put it, shift from defense to offense, what needs to happen? What are the key catalysts we should be watching for?
Okay, number one, they need to show the sequential revenue growth in Q3, even if it's modest. Just stop the bleeding, essentially. Number two, they absolutely have to deliver on that Q4 profitability target, 8% or higher, adjusted EBITDA margin. Hitting that would be huge for credibility. Number three, eventually those big delayed production deals need to actually close, especially the ones in auto and aerospace they keep talking about. Seeing those land would validate the delayed, not canceled narrative. And finally, frankly, a better macro environment wouldn't hurt. Improvement in overall economic conditions, maybe some renewed appetite for risk in the tech sector, perhaps reflected in that PRNT ETF starting to perform better overall.
Makes sense. It's a combination of internal execution and external factors. They're trying to position themselves for the long haul, aligning with big trends like localizing supply chains, next-gen mobility, sustainability, efficiency, but they need to navigate this choppy near term first. Okay, time to step into the hypothetical investment committee room. Standard disclaimer applies here, of course. This is absolutely not financial advice, just exploring ideas. So the market has hammered Stratasys stock. The guidance cut triggered a classic sell the news reaction, pricing in a lot of uncertainty. But as we've discussed, maybe the market is missing some underlying strengths.
Well, we've covered them. That rock-solid balance sheet, over $250 million cash, zero debt, boosted by Fortissimo. The active cost-cutting that's showing results. Picking up valuable IP on the cheap from struggling rivals, those R&D shortcuts.
And maybe most importantly, those real-world production-grade wins with giants like GM and Toyota. That's proof the tech works at scale. Then there's that critical Q4 target. Hit 8% or higher EBITDA margin, even with lower revenue. And management regains a lot of trust. The big deals are pushed out, yes, but supposedly intact for 2026.
So the argument is the market is punishing the timing issue perhaps excessively and overlooking the fundamental business strengths and the potential recovery.
Exactly. Which leads to an outrageous but plausible trade idea. What about a long-dated out-of-the-money call option on Stratasys? Think, say, June 2026 expiration. Gives you plenty of time. And a strike price maybe somewhere in the $12 to $15 range. It's well above where the stock is now, hence out of the money.
Okay, unpack the thesis behind that specific trade. Why long-dated calls?
The thesis is straightforward. You believe the market has overreacted to the timing delay. You believe management can execute on cost discipline, proven by hitting the Q4 target. You believe the pipeline is strong and those big deals will close, likely in 2026. This long-dated option gives you nearly 2 years for these catalysts to play out. Time for Q4 results to land, time for the macro picture to potentially improve, and time for those delayed deals to finally get signed.
So you're essentially betting on management's execution, the underlying tech adoption, and maybe an industry shakeout where Stratasys emerges stronger, all playing out over the next 18 months or so. The option structure gives you leverage if you're right, while defining your maximum risk.
Precisely. It's a bet on the recovery narrative and management delivering on their promises, especially that Q4 profitability. A long game bet reflected in the long-dated option. So wrapping this up. What we've seen today with Stratasys is, well, a company clearly facing challenges. Macroeconomic headwinds are real. Those sales cycles for big deals are stretching out. That's undeniable.
Yeah, the near-term picture is cloudy, but look under the hood and you see management actively managing what they can control. Disciplined cost-cutting, protecting that strong balance sheet, making opportunistic acquisitions, and, crucially, still landing significant customer wins and pushing innovation.
They're definitely trying to build a foundation for long-term growth, aligning with those big mega trends we talked about. It really comes down to that tension, doesn't it? The market's immediate pessimism versus management's confidence in their future execution.
It makes Stratasys a really interesting case study right now. A reminder that earnings calls often tell two stories: the short-term numbers and the long-term strategy. And the market doesn't always value them the same way.
Indeed. And remember, everyone, this deep dive was purely for informational purposes. It is absolutely not financial advice. Please do your own research before making any investment decisions.
Always.
We're curious, what did you take away from this Stratasys deep dive? Did anything surprise you? Let us know your thoughts. Until next time, keep digging for those insights.